The stock for OPENDOOR Technologies, Inc., ticker symbol OPEN, closed yesterday, December 3, 2025, at $6.94 per share, marking a slight down move of minus $0.05 or about minus 0.72% on the day from its open. Since the market is closed, we must rely on this most recent closing data, noting that the intraday high reached $7.12 and the low touched $6.86. Now for the insight that should capture your attention. While the market narrative is fixated on the company's recent Q3 revenue drop, a significant 34% year-over-year decline that saw the stock dip sharply, the more interesting development is the dramatic shift in its inventory strategy and its implications for working capital. Most investors see the reduced inventory as a sign of shrinking business in a difficult housing market, but the internal reality is a conscious, aggressive pivot to preserve capital. OPENDOOR has dramatically tightened its buy box, which is the range of homes it's willing to acquire, in an attempt to cycle inventory faster and achieve higher unit margins. This isn't just a reaction to the macro environment. It's a strategic de-risking maneuver that completely changes the company's dependency on favorable housing market conditions, effectively trading volume for profitability focus, which is a subtle but critical difference from the widely held belief that they are simply struggling to buy and sell. The common expectation for OPENDOOR is that it is a direct proxy for the housing market, a highly cyclical, interest rate-sensitive play that only works when rates are low and inventory is moving quickly. The company's core business model, iBuying, involves using technology to make near-instant cash offers on homes, quickly taking them onto their balance sheet, performing minimal cosmetic work, and then reselling them for a profit, the very definition of a high-volume, low-margin operation. This model relies heavily on debt and having a significant cushion of working capital to manage the large quantity of homes in its inventory, which are essentially commodities that can devalue if held too long in a cooling market. When the Federal Reserve started raising rates, the market's expected reality started to become brutally evident. The inventory OPENDOOR held started to lose value, leading to severe quarterly losses. The latest quarter saw a net loss of $90 million, a figure that certainly aligns with the pessimistic narrative. And yet the company managed to achieve positive operating cash flow of $435 million, which is the unexpected counter-narrative. This cash flow swing, while partially due to reducing inventory, shows an ability to quickly monetize assets when the pressure is applied, offering a flash of operational dexterity that many critics overlook when focusing solely on top-line revenue. Looking closer at the recent stock movement, the past few months have been highly volatile, indicative of a stock that is deeply split between retail enthusiasm and institutional skepticism. The stock price has traded in a wide range, having soared from its 52-week low of about $0.51 to a high of $10.87 earlier in the year, a move largely fueled by broader speculative interest and the hope of a quick drop in interest rates. The subsequent cooling, which brought the price back down near the $7 range, was triggered by the Q3 earnings report, where the sharp revenue miss and persistent losses overshadowed the subtle improvements in unit economics. Volume on days following the report was high, signaling a significant institutional rotation out of the stock, but also a strong retail buy-the-dip response. Average daily volume is exceptionally high, sitting at around 106 million shares, which is not surprising for a stock with such high retail engagement,
particularly one that has been a magnet for market discussions on platforms like Reddit and X. This high volume, especially on down days, needs to be interpreted with caution. It's not just selling, it's a high churn environment where new buyers are absorbing shares from long-time or momentum-focused holders who are abandoning the trade. The sector momentum remains a significant headwind. The broader residential real estate sector is struggling with low transaction volumes due to high mortgage rates and a persistent shortage of inventory at the entry-level price points. OPENDOOR, despite its focus on digital transactions, cannot escape the gravitational pull of these macroeconomic pressures. This is the reality that continues to challenge the expectation of a rapid turnaround. Management is now forecasting a 35% increase in home acquisitions for the fourth quarter, targeting 6,000 homes by the end of 2026, with a stated goal of achieving adjusted net income profitability by the end of 2026. These targets, while aggressive, are predicated on their refined pricing algorithms and tighter risk management, suggesting they believe they can execute the iBuying model more profitably even in this challenging environment by focusing on a much smaller, more predictable subset of the market. The core belief they are working to establish is that they can decouple their unit economics from the broad market cyclicality through smarter technology. Now let's address the elephant in the room: short-selling activity. For a stock that has experienced such dramatic price swings and operates in a capital-intensive, loss-making industry, the short interest is naturally high, creating significant pressure. The latest short interest data from mid-November showed approximately 127.36 million shares short, representing a notable 16.28% of the public float. The days-to-cover ratio, sitting at around 1.72 days, is relatively low compared to extreme meme stock situations, which means it would take less than 2 full trading days for all those short positions to cover if a sudden wave of buying forced them to. This low number dampens the immediate threat of a short squeeze, yet the sheer volume of shares held short confirms the institutional skepticism. The short thesis is straightforward. OPENDOOR's model is fundamentally flawed in a high-rate environment, leading to persistent inventory losses, cash burn, and an inability to scale without constantly diluting shareholders or taking on expensive debt. The recent insider selling, which saw the chief financial officer divest a significant number of shares, only adds fuel to this fire, prompting short sellers to double down. The cost to borrow the stock, which is what short sellers pay to temporarily use the shares, has been relatively low, hovering at around 0.40% recently. Low borrow rates indicate that there is an ample supply of shares available to borrow, meaning short sellers are not currently feeling a major supply pinch that would signal an impending squeeze. However, retail investors need to monitor this rate closely. A rapid spike in the borrow fee, especially when paired with a sudden increase in trading volume, is a classic warning sign for short sellers that a countermove is underway. The off-exchange short volume is also noteworthy, with figures often ranging from 30% to nearly 40% of the total volume on certain days, which shows substantial shorting activity occurring outside the main public exchanges, often in dark pools. While this is legal, it contributes to the market debate on transparency and price discovery, a topic frequently discussed on investor forums. To the retail investor looking for actionable steps in this context, the first step is always to be aware of where to find this data. Short interest figures are released on a bi-monthly basis, but real-time data like borrow rates and short availability can be tracked through various financial services. Interpreting a spike in the cost to borrow should not be a signal to immediately buy, but a signal to investigate why the supply is drying up. Is it because a large institution is recalling shares, or is it due to a sudden surge in buying interest? A responsible approach is to look for a multi-day pattern of high volume and price appreciation that sustains the move, rather than chasing a single-day spike that can easily turn into a trap. We have seen some failure to deliver data spike in mid-November, reaching over 5 million shares on one day, which is a sign that some transactions were not settled, adding a layer of complexity to the short narrative, but these numbers have since come back down to more modest levels. What's your take on the rising short interest, smart money, or manipulation? Comment below how many shares of Open you currently hold, or if you're holding a short position, and why. This level of institutional opposition, while daunting, also